Raymond here with our episode 12 of the financial statement analysis videos in our financial statement analysis series for the German industrial stock list. If you're new to my financial statement analysis videos, what we do in these videos is we analyze the top three financial statements relevant to a company, those being the income statement, the balance sheet, and the cash flow statement. And after that, we look at the key factors of each statement and we attempt to come up with an overall image of how well the company is doing financially, given the past, present, and hopefully we can use the past and present financial results to predict how well the company will do in the future and to determine whether or not the company will be a good investment. So without further ado, we're going to start off with the key ratios. As you can see, I've already invested £1. I'm not too sure exactly the date I invested that pound in there, but I've received an 18% return on my investment, which is good. So let's get into the key ratios. So the market cap, which is the overall price of the company, is 285 million euros, which of course is less than 1 billion euros, which of course is not the best, but I've seen worse. So the PE ratio is 9.43, which is around the 10 mark, which is I would say is a very good level. The revenue figure, which is the overall sales of the company in the last financial year, was 488 million euros. The earnings per share was 2.79 euros, and the dividend yield, which is the overall cash amount that the company paid out to its shareholders per share, was 3.73%. And the beta level is 1.2, which is about 20% above the market average of 1. The beta level is just the risk level based on the volatility of the stock up to today's date. So let's get into the first of the income statements. Sorry, the first of the financial statements, that being the income statement. So as you can see, the graph shows the light purple figure is the revenue sales figure of the last three financial years. The 2019 financial year was around 575 million euros. And in the 2020 financial year, the sales figure dropped quite substantially to around, I would say around 60% of the 2019 figure, as well as the profit margin. So the 2019 financial year, the company made a positive net income of around, I would say, 4%. I think that's a safe estimate, around 4%. And in the 2020 financial year, the company's revenue figure dropped quite substantially, and the company's net income was negative. I would say around negative 2.5%. In the 2021 financial year, the company managed to recover and increase its its revenue figure by about 10%. Still less than the 2019 financial year, but it was still a recovery and a gain. And the net income was higher than the 2019 financial year. So it's arguable, it's debatable which year was actually better financially out of the 2021 financial year and 2019 financial year. I would say from a shareholder's perspective and actual shareholder, I would say the 2021 financial year was definitely better because it's because of the profit margin to revenue ratio. Prospective shareholders as well as existing shareholders always look at the profit margin as a more important figure than the revenue figure, because the profit margin is actually the figure that determine the profit margin is what the company keeps, and thus what the shareholders get as a return on investment. The revenue figure is only a pre-existing figure before taxes and other deductions have to be made. So it's not an actual representation of what the shareholders will receive. It does show to an extent how well the company has done productivity wise, but it doesn't show how well the company has done from a final production perspective. So let's get into the balance sheet. The balance sheet does show the total assets as a ratio to the total liabilities. The total liabilities include debt in the form of cash and other capital assets, and the assets show what the company controls and owns. So the assets of this company would be the light purple figure, which you can see is quite high. In 2019 financial, it was around 526 million euros. In the 2020 financial year, it was quite a bit less, around 420 million euros, which is about a drop of for 100 million euros, or about 20%, which is quite a substantial amount, as we saw in the change in revenue figure in the income statement. And also the liabilities figure also changed. It decreased quite substantially in the 2020 financial year. It almost halved. I would say it roughly dropped by about 50%. It's good that it done that, as opposed to well, in relation to the drop in total assets, because the total assets is what the company owns, which is of more interest to the shareholder from a strategic benefit perspective, compared to the total liabilities. Because the total liabilities, the only thing that has to be satisfied with regards to total liabilities of a company is that the total liabilities are less than 50%, or at least low enough that the shareholders can make a decent return on investment. Considering that, yeah, at least, or if it's low enough that the interest that has to be, the interest payable on the debt doesn't have too much of an impact on the net income, and thus the return on investment to shareholders. So let's look at the 2021 financial year. The the total assets figure jumped up again to close to its 2019 figure, but not quite, up to around 500 million euros. So a good recovery there. And also the total liabilities increased slightly by about the same percentage as the total asset increase. It is a good thing that the total assets increased, as not a good thing that the total liabilities increased. So it's debatable whether or not that was a good trade-off, or whether or not it was worth it for the total assets to increase and at the same pace as at the same percentage as the total liabilities increase. I think a lot of people will say it is a good thing, simply because it's not as though adding the same percentage of debt cash wise as assets will have the same effect. Total assets have a more positive impact. An increase in total assets has a more positive impact on a company and prospective shareholders, as well as current shareholders. Has a more positive impact than a total liabilities increase. So it's definitely so having an increase in total assets outweighs the positive impact of a total liabilities increase. So I think most people would say it was a good trade-off. So let's get into the cash flow statement, which is the last of the financial statements. So as you can see here, let's get into the 2021 financial year shows that the net income, or the starting line, was 29.46 million euros. The cash flow from operating activities was 51.7 million euros. The cash flow from investing activities was negative 31 million euros. The company spent 7.89 million euros on capital expenditures. Most of the cash flow from investing activities went towards other investing cash flows. The cash flow from financing activities was a negative 11.42 million euros, none of which was due to dividends paid. A lot of which was due to about 9.13 million euros was due to retiring debt, so eliminating debt, as we saw with a slight decrease in liabilities in the from the 2020 financial year to the 2021 financial year, when we were looking at the balance sheet. The foreign exchange effects are quite trivial. They're not very large, so let's just ignore that. The net change in cash overall was 8.49 million euros. Let's just check the difference in net change in cash from each financial year. 20.77 million euros in 2020, and in 2019 it was negative 6.5 million euros. So it done a good job from the 2019 to 2021 financial year. Gained quite a lot of cash, or at least it managed to store a lot of cash. But from the 2020 to 21 financial year, it managed to lose about 12 million euros. But it's not as though that's a bad thing. The company clearly is spending the money on things that will improve the overall business structure and improve the productivity of the company, as well as reducing debt. So that helps to increase profit margins and net income for shareholders. So the company is not necessarily doing a bad job with regards to managing its cash. So without further ado, I'm going to close this video. Thank you guys for watching. I will see you in the next one.